Every February, the South African Minister of Finance delivers the national budget speech to the members of Parliament, the President, and most importantly, the citizens and residents of South Africa. In this video, we explain the budget process in South Africa and why you should care about the minister's budget speech. Welcome back to Public Administration 101. This video forms part of our latest series, which we titled Public Finance Management. This is where we aim to provide you with a clearer view and a basic understanding of public finance management within the South African context. In this video, we will define what the national budget is and why governments prepare budgets. We will then give an overview of the various laws governing the budget process in South Africa, as well as the key documents used in the national budget process. We will also discuss the South African government budget process in detail. We will then conclude with reasons on why we believe you should care about the minister's national budget speech. But before we get into it, also remember to subscribe to this channel. And don't forget to turn on the notification button to be alerted when we publish new videos. Now that you have subscribed, let us get into today's video. So, what is the national budget? A national budget is essentially the budget of the country. This budget represents all the money received by the government, which includes taxes, investments, loans, and donations, and how government intends to spend such money on the various government services and projects. So, why do government prepare budgets? Since the money that government receives is usually limited, that is why government would allocate these limited resources to various governmental activities that are strongly aligned with the constitutional mandate and the priorities of the governing party. These activities include government services and government projects, such as the National Defence Force, government infrastructure, education, sports, arts, and culture, social and welfare programs such as social grants, or how government intends to repay its own debt. Therefore, governments prepare budgets to ensure that every item of its expenditure is well thought out and properly allocated, and is according to the law. Which brings us to our next segment, relating to the various laws and regulations that govern the South African budget processes. These laws and regulations play an important role in ensuring that the budget serves as a practical tool used by the government to translate its plans and policies into tangible goods and services for the benefit of its citizens and its residents. Some of the laws and regulations that govern the national budget process in South Africa are as follows. First and foremost is the Constitution of South Africa, which provides for the equitable share and allocation of revenue among all three spheres of government. The Constitution further provides that budgets and budgetary processes must promote transparency, accountability, and the effective financial management of the economy, debt, and the public sector. The Constitution further provides that there must be an Act of Parliament, which prescribes a. the budget formats, b. the timelines and deadlines when such budgets must be tabled, and lastly c. that such budgets must reflect the various sources of revenue and how the proposed expenditure complies with national legislation. The other legislation, which govern the national budget process, is the Public Finance Management Act, commonly referred to as the PFMA. This act empowers the National Treasury to manage the budget preparation process, as well as control the implementation of the annual national budget, including any adjustments thereto. The PFMA further provides for the tabling of the national budget annually by the Minister of Finance to the National Assembly. To learn a bit more about the PFMA, please refer to the video titled The Introduction to Public Finance Management Act under our channel. We have also included the link to this video in the comments section under this video. While you are there, please check out the various videos relating to municipal budgets. The links to those videos are also included below. This is also a good opportunity to remind you to click on that subscribe button to support the channel. And remember to turn on the notification button so that you don't miss out when we post new videos. Now back to the video. The other legislation governing the national budget process in South Africa is the Division of Revenue Act, or DORA. This act essentially provides for the allocation of funds between the various spheres of government, as required by the Constitution. The Act also provides for the equitable division of the government's revenue amongst the national, provincial, and local levels of government. The Act also determines each province's equitable share of the budget and allocations to provinces, local government, as well as to municipalities. Furthermore, the Act spells out the responsibilities for all three levels of government relating to such division and allocations. Another relevant legislation is the Appropriation Act, which provides for the allocation of money from the National Revenue Fund of the state, and prescribe conditions for spending such funds. Another legislation is the Intergovernmental Fiscal Relations Act, which promotes cooperative governance between the three spheres of government. There is also the Money Bills Amendment Procedure and Related Matters Amendment Act, which allows Parliament, amongst other things, to amend the budget. Over and above the laws already stated, there are also several key documents used by the South African government to prepare the national budget. And these are guidelines and templates issued by the National Treasury. These guidelines are based on government policy, such as the National Development Plan. Departmental Annual Strategic Plans. These annual strategic plans indicate what the department's plans are for the upcoming financial year, and the budget amounts required in order to achieve the implementation of such plans. The Medium-Term Strategic Framework. This document attempts to translate the government's 5-year plan into programs of action. The Medium-Term Budget Policy Statement. This is a document tabled in Parliament by the Minister of Finance, which contains the macroeconomic assumptions underpinning the government's fiscal policy. The Medium-Term Budget Policy Statement also outlines the overall aims and objectives for the next 3 years, as well as government's projected revenue and expenditure for the next 3 years. The Budgetary Review and Recommendations Reports. Parliament rely on these reports to annually assess government's performance and audit outcomes. Another key document is the State of the Nation Address by the President, or the SONA. The SONA can also be seen as the foundation for the beginning of the budget process. This is where the President outlines the country's priorities and the government's plans. This leads us to the next segment of our discussion, which is the budget process. In this context, we are only going to restrict ourselves to the process followed by the South African government to prepare the national budget. Generally speaking, the budget process for the South African government can be divided into 4 stages. And these stages are as follows: the planning stage, the legislative stage, the implementation stage, and the evaluation stage. It is important to note that these stages do not coincide with the unfolding of a single fiscal year. The first stage, which is the planning stage, takes place before the beginning of a particular fiscal year. This is where the National Treasury issues spending guidelines to government departments. These guidelines are based on government policy, such as the National Development Plan, or the NDP. These guidelines are also located within the Medium-Term Strategic Framework. which provides for a 3-year budget framework. Based on these guidelines, government departments and other state institutions submit their draft budgets. During this process, consideration is also given to any unspent funds in any given department, and decisions must then be made as to whether these unspent funds can be rolled over into the next budget period. Speaking of rollovers, these are actually formal requests made to National Treasury regarding any unspent amounts to be carried over from one budget period to the next. Following the submissions by government departments, the National Treasury then consolidates all the budgets into draft budgets to be tabled before Parliament. Parliament plays an important role in the drafting stage through its oversight work, which is spelled out in the Money Bills Amendment Procedure and Related Matters Act. The second phase of the budget process is the legislative stage. This is when the national budget package is tabled in the National Assembly by the Minister of Finance. This is typically done in February each year. The Finance and Appropriations Committees from both Houses of Parliament would then consider the proposed budget allocations for departments and other state institutions. These committees would then hold hearings on the fiscal framework, the division of revenue, and the revenue proposals. The law specifically makes provision for public participation during this stage, which allows for the input from civil society and other interest groups. Parliament would then typically pass the budget 4 months after the start of the financial year. The adjustment budget process is then introduced 6 months into the financial year. This is the process which provides for any adjustments to departmental budgets. Once the budget has been passed, funds can then be allocated to government departments and other entities. That is when the implementation of government plans and projects can thereafter begin. The portfolio committees of the National Assembly, and to some extent, the National Council of Provinces, are mandated to monitor and assess the performance and expenditure of their respective government departments against the budgets, and to ensure that the funds are spent effectively and efficiently. Probably one of the most important tools used by Parliament for this purpose are the budgetary review and recommendation reports. These reports require parliamentary committees to annually assess government performance and audit outcomes, but also allow for the National Assembly to make proposals on the use of resources. These reports also provide an assessment of every government's service delivery performance, even their allocated resources, and whether the expenditure incurred can be considered value for money. Parliament would then use these reports to make recommendations on revised allocations, where necessary. After the financial year comes to a close, it is time to assess government departments' spending, and how such spending is reflected in the delivery of services and the achievement of planned objectives. This is when finances of the various government departments and state institutions are scrutinized, evaluated and audited by independent audit institutions, such as the Auditor General. Audit reports are then published and presented to Parliament to be reviewed and for accountability. Although most people would hear about the national budget when it comes to the budget speech delivered by the Minister of Finance around February, such process normally takes months and months of work to prepare. In other words, by the time the national budget speech is delivered, the process of preparing the budget for the following year would have already begun. The process is lengthy. This is because there are a number of time-consuming processes which must be completed first. In the following segment, we will illustrate the general timetable for the national budget process. But first, you need to understand that each budget is part of an ongoing 3-year plan called the Medium-Term Expenditure Framework, MTEF. These MTEF technical guidelines are issued in accordance with Section 27(3) of the Public Finance Management Act. The guidelines essentially provide national government departments, as well as other state and public institutions, with guidance on how to prepare their medium-term budget estimates. While primarily intended for national government departments and national public institutions, the guidelines also contribute to the budgeting process in provinces. Now let's take a look at the budget calendar in detail. In April, the National Treasury would issue departments with guidelines for requests for rollovers of qualifying unspent funds from the previous financial year. And at the end of the month, rollover requests are submitted to National Treasury for assessment. Between May and June, the National Treasury would then issue medium-term expenditure framework budget guidelines and request 5-year expenditure estimates or plans from government departments. Based on these guidelines, government departments are requested and expected to submit their expenditure estimates to the National Treasury for the upcoming budget year, usually around July. Analysis and approval of changes to departmental budgets would then be considered. Around August, the Ministers' Committee on the Budget will then approve the preliminary division of revenue and budget priorities. The Medium-Term Expenditure Committee would then, around September, present its initial recommendations for funding allocations for key government priorities. In the middle of the financial year, being around October, budget review and recommendations reports are tabled in the National Assembly. As previously indicated, these reports are used to assess previous performance by each government department, which means that recommendations may also be made for changes towards any future allocations. Also in October, the medium-term budget policy statement would also be tabled in Parliament. This must be submitted to Parliament at least 3 months before the introduction of the national budget. As stated before, the medium-term budget policy statement is essentially a reflection of the country's macroeconomic view, which highlights key government spending priorities, as well as the size of the spending envelope for the next medium-term expenditure framework period. The medium-term budget policy statement also gives some indication of what the following year's budget may include. Allocations to national government departments are then finalized and proposed to Cabinet around mid-November. Once Cabinet approves funding, allocation letters are sent to all government departments. During February, this is when the budget, which comprise of the fiscal framework, the appropriation bill, the division of revenue bill, and related budget information, is finalized and tabled by the Minister of Finance in Parliament. This is not the final budget, but a proposal that has to be scrutinized and approved by Parliament. So, what happens after the Minister's budget speech? From around March to around June, the National Assembly and the National Council of Provinces would refer the fiscal framework to their respective finance committees. Parliament would also consider and then adopt the division of revenue bill for the upcoming year. The public would then be invited to make inputs on both these instruments. Thereafter, Parliament considers the inputs from the public and then approves each departmental budget. Around July, the appropriation bill is passed by Parliament, and based on this, funds are then allocated to departments on a monthly basis. The Constitution specifies that government can only spend money, provided that it has been approved by Parliament. This is why the National Assembly votes to pass the budget through the appropriation bill. Once the funds have been allocated to government departments and other entities funded by National Treasury, government plans and projects can then be implemented and carried out for the duration of the financial year. Throughout this time, Parliament is tasked with the role of monitoring and reviewing government departments' expenditure. In conclusion, why does the national budget speech by the Minister of Finance matter? One of the implications for individuals is that the budget speech may introduce changes in personal income tax, fuel levies, and sin taxes. Sin taxes are taxes specifically levied on certain goods deemed harmful to society and individuals, such as alcohol, tobacco, etc. Any increase of taxes and levies brought about by the minister's budget speech could decrease the disposable income of individuals. Another implication, which could be brought by the budget speech, is changes in corporate income tax, or maybe the introduction or removal of tax business incentives, expenditure deductions, and assessed loss offsets for companies and other businesses. This could therefore have an impact on the bottom line of affected businesses. The national budget speech is therefore a good opportunity for individuals to reflect on the state of their personal finances and better plan for the year ahead. Companies and other businesses trading in South Africa also need to pay close attention to the national budget speech by the Minister of Finance for any pronouncements that could affect their bottom line. This video was proudly brought to you by Kano Consultants. For professional advice you can trust. Remember to like, comment, and share this video. And if you haven't already, don't forget to subscribe to this channel for more content. Thank you for watching. If you would like to continue the conversation, please follow us on these social media platforms at ConsultKano or #ConsultKano. Until next time, please check out our other videos by clicking here, or search for other videos on our channel. And click on that subscribe button so that you don't miss out on more content.